Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is one of my favorite commentators on the markets. He is Dr. Chris Martenson of peakprosperity.com, and I've been following his work since 2007 when he created the Crash Course around that time, which was a video series, and subsequently he came out with a larger, more detailed book about it. So thank you for joining us here today, Chris.
Thanks, Jason. It's a pleasure to be here.
Thanks, Chris. Now, I found your work in 2007, and it was very, very prescient. I just started to wake up. I just started to learn about investing in the financial markets and some of these important top-down concepts. And the mainstream media wasn't talking about anything in there. So one of the most important things I saw in your work is talking about precious metals. The precious metals have had a very rough correction over the last 2 years. How much of this correction do you think is based on market manipulation? And do you think the end of June was a secular bottom?
Well, I'll tell you, I have this view that we know the price of everything but the value of nothing right now. There's a lot of distortions in our overall markets, and gold and silver are certainly heavily distorted. And anybody who's been paying the slightest bit of attention knows that there are elements on Wall Street that go ahead and make money using means that are less than fair, less than free, less than honest. Honestly, they should be criminal or outlawed, and I think in many cases they actually are. And yet we find no regulatory action being taken against large institutions, large players who routinely skirt the system. I mean, we've seen SAC Capital get taken down for some pretty obvious insider trading, but we see, where I sit in looking at my trading screens, I see very obvious manipulations in the markets, very obvious manipulations in the gold and silver market. They just happen routinely, time and time again. Somebody will pour 2,000-3,000 contracts into the overnight market where there's maybe a bid structure to absorb a fraction of that, drive the price almost inevitably downwards, and wash, rinse, repeat. So somebody's making a lot of money at distorting the precious metals markets, and that's been my view for a long time. But I got to be honest, I've seen that same set of distortions happen in other markets at other times, other commodities in particular, because the futures markets are thinly traded and easy to manipulate a bit. And to really understand why I don't advise people trade these markets anymore, I was a trader for a period of time, is because it's really become the Wild West. There are no rules, there are no laws. There are now companies that see the complete market structure. They're not just banging on gold futures when they're doing that. They are first buying puts across the GLD structure, shorting GLD itself, buying puts on large minor equity positions. They basically blanket the market and then jam the futures and then unwind their positions. So the only thing that's mysterious to me is why we've only consistently seen these large downward spikes in the overnight market to the downside. That's the odd part in this, which makes me suspect that the regulators in the U.S., they're okay when you do that. I bet if somebody started jamming it the other direction and raiding the bullion banks in the overnight markets, you'd see some regulatory oversight really quick. So that's as close as I can get to saying there is something close to what I think is official support for the kind of action we're seeing in the precious metals, but that's speculation at this point. I'd have to see if the regulators really did come out of their caves, if there was some strong upward manipulation attempts.
Yeah, and that's a good point. And you have some of the CFTC commissioners like Bart Chilton and others come out and say there is some stuff going on in there, and then nothing's followed through on the investigations. And then you are in some other commodity markets. You have like aluminum. You have J.P. Morgan and Goldman Sachs and those guys. And I think manipulating electricity prices on top of that. So you do have these guys who are big players, who want a sure thing, and they look for ways to rig their markets.
Oh, absolutely. The aluminum cases couldn't be more obvious. What they've done is they've taken record amounts of aluminum, stuffed it into warehouses, and then basically forced anybody who wants to get delivery of the aluminum that they've legally bought through the futures of the forwards market to pay a premium. I'll call it a scalping fee or some kind of criminal usury on top of that if they will actually want their metal delivered because they own the warehouse stocks. Or listen, these guys will do anything possible to make money, and they've shown absolutely zero compunction about doing things that are patently, as far as I'm concerned, illegal, but certainly amoral and not in the spirit of a free and fair market. And we've seen the regulators just drag their feet in every single case. So if it looks like a market of, by, and for the big banks, the ones who turn in 100% win ratios every trading quarter, if that doesn't sound like they're trading in a market with any risk in it, you're right. And that's the game. So that's why, again, I circle back and say, if you want exposure to gold and silver, don't trade them unless you're willing to know, what kind of a pool you're swimming in and what kind of sharks are there with you. Otherwise, get your gold and silver at core position. It's going to help protect you for what I'm almost positive is coming, which is a pretty major currency crisis. I don't know when. Is it next week? Is it 10 years from now? I don't know, but it's clearly coming. And on that basis, I do think we've put in a bit of a low on gold and silver, and silver in particular. They're two separate metals to me. The silver story just gets better and better from a fundamental standpoint, but we're not trading on fundamentals yet.
Yeah, and I think we're eventually going to get there because the physical market is completely starting to decouple from the paper market. You had a situation where the paper prices were pushed to prices where the miners could not produce supply at a profit, and if we had stayed at those prices back towards April, through the takedown in April and towards the end of June, if we had stayed at those levels or lower, you were going to see miners start to go bankrupt in 12 to 18 months, and you were going to see a humongous amount of supply for both metals start to come offline, and this was in the face of rising physical demand. So it just baffled me. I knew it could not continue indefinitely. It was not a word you like to use, sustainable. It was not sustainable at all. It was not a sustainable market. It was obvious that could not continue.
Well, obviously, in the Asian demand, India and China pulling down 70% of all newly mined material in a single half of the year is just an extraordinary development. So from a fundamental standpoint, I have not seen any more bullish conditions for gold in the entire time I've been tracking it. And yet the price action, it's just weak, and it gets, slaughtered at every key, technical level. And it's trading. I think the people who are trading gold are going to be extremely disappointed at some future moment. And when that market does finally decouple and finally blows up on them, and it will someday, I have every confidence that the regulators will finally ride in, declare force majeure, and allow the big bullion banks to skate away from their obligations to deliver metal and allow them to settle for paper. And that'll be the exact wrong moment to want paper instead of metal. And so for everybody who thinks they've got gold exposure, they're in a fund, they're in a fund of funds, they're in a hedge fund, they've got something where there's actually a claim on gold, I'm not even confident that somebody who feels like they have a warehouse receipt that has a number on it, that has their name on it, that says that's theirs, that they have any real claim to that, because that's what MF Global taught us. People who owned warehouse receipts, not a futures contract, those were just undone like that, but people who had warehouse receipts for physical gold with a bar number on it were told, here's your cash.
Yeah, I think that's a good point. I think a lot of the allocated accounts, we've heard this from Jim Sinclair and others with a lot of context in the gold industry, allocated accounts have already started to be cleaned out when they're not supposed to. That's supposed to be a felony, right, to go in there and steal from an allocated account.
Mm-hmm. Oh, absolutely. So if it looks lawless, smells lawless, tastes lawless, it's lawless. And so that's why I'm a big, big believer in owning physical bullion. I'm very skeptical of those allocated accounts. They're not all created equal. I do believe that companies who have private vaulting solutions, those are a higher up the rung for me. Because sometimes people need to have gold in vaulted storage and silver in vaulted storage, and I understand that, and it makes sense. You do it for jurisdictional reasons. You do it because you don't want to have that much money, wealth lying around in your house. It's for safety reasons. It's for peace of mind. I get that. So I do believe that there are private vaulting solutions out there that work. But if you're in a UBS vaulted account or a Deutsche Bank vaulted account or a JP Morgan vaulted account, and you think you've got allocated precious metals, I'm pretty sure that's not true. I think you're at risk there.
Yeah, I would definitely agree. And you have guys like JP Morgan, HSBC, and those are the custodians of SLV and GLD. So those are the two main ETFs that worry me the most, because most people plow into those when they want to buy gold and silver. And, I just try to warn them not to, but, they're going to learn the hard way.
Well, and this is something I've studied extensively to try and peel back and understand what's happening in the whole gold leasing world. You know, Grant Williams had that really nice piece on hypothecated gold and how we have a fractional gold reserve lending system, banking system out there potentially with lots of players thinking they own title to the same bar. That's a possibility that exists, but it's a very opaque market. It's really secretive. It's very hard to understand what's happening there. And for most of your listeners, you know, I got some very good information that the OTC market, the London bullion market, it's huge compared to the COMEX market. So we see all of this attention and focused on, is there 9 million ounces? Is it dropped to 20% in COMEX? But that's a tiny, tiny piece of the overall daily flow of gold and the amount of stock of gold that's available to go into the flow. So trying to get into and understand what's actually happening with the stock and flow from the London market, very, very hard to do. With the only piece of information we got that was fascinating was that over 700 tons shipped out of London in a single quarter this year. That's as close as we can get to the flow in that market. That's an amazing statistic.
Yeah, and the Bank of England supposedly sold, I believe, 1,300 tons of gold, and they only own about 400 tons. So it's the numbers are fuzzy math, and it's accounting gimmickry, and it's just becoming kind of ridiculous. Seeing these stories come out.
Well, it's true, and there's one other factor in there which we don't know about. Which I was talking with somebody who's very deep in the industry, and he asked me a very good question. He said, "Where do you think all the Iraqi gold is? Where's the Libyan gold?" We know that there was gold, lots of gold in both those countries, and it's fully unaccounted for. So the suggestion was that some of that gold has been cycled back through into the London market somehow by hook or by crook. So that's a possibility as well. There was a lot of tonnage that's gone missing in those conflicts. So really trying to, and plus there's gold smuggling all the time. So really understanding what's going on in that market is very, very difficult. But the two things I really count on are that India's buying a whole lot of it and China's buying a whole lot of it as point one. And then point two is I believe that the Western nations pretend like gold doesn't matter, but that there will be a pain point at which they say no more gold can go from the west to the east. And how they shut that off, the honest way would be to allow prices to rise so the east loses its appetite for it. The dishonest way will be to shut the gold markets down one way or the other.
Yeah, there's definitely a wealth transfer going on from west to east, and it used to be the wealth transfer for hundreds of years went from east to west. Switching gears here now, let's talk about the economy, because gold is starting to become an important part of world trade again. It's starting to be where countries who run trade surpluses store their reserves instead of all in U.S. dollars and U.S. treasuries. Keynesian academic economists like Carmen Reinhart and hedge fund manager Ray Dalio have written long white papers calling for financial repression or a controlled worsening stagflation to help the U.S.'s debt problem. Do you think the Fed can follow this blueprint successfully for years and keep the game going?
Well, they have been able to keep the game going, but because and only because they've had complete unity with the Bank of England, the ECB, and the Bank of Japan. So collectively, those cover the majority of the OECD nations, and that's where most of the wealth is stored. And it's only possible for the Fed to do what it's doing because those other central banks are essentially looking the other way and or participating. So if you'd taken me 10 years ago and said, Chris, here's what's going to happen. The Fed's going to be monetizing over 70% of the federal deficit, and the dollar's going to be stable and interest rates are going to be low, I would have said you're nuts. So that's a bit of a surprise to me, but it really only can be explained in the context of the idea that the dollar is the best horse at the glue factory, meaning all the currencies are being debased in the same way. So you get back to the very important point you just made, which is that flow of wealth has now shifted. The tide has shifted and is going from west to east. Real wealth is real stuff. Paper money is a claim on real wealth. Debt is a claim on money. So when you follow that chain through, this idea that the East is accumulating more and more and more real wealth, and we see it not just in gold and silver, but China's got its magic checkbook. It's buying copper mines and land rights and oil concessions all over the world. This is really, if you want to understand what's happening in the Middle East right now, you can forget about all this, is it a humanitarian issue? What's happening is there is a final positioning going on now for some of the world's last and most abundant and best resources. And so from my perspective, there's a huge strategic blunder being undertaken by the West, which is we're going to try and secure our access to that wealth through gunboat diplomacy. China's doing it right now through the miracle of checkbook diplomacy. And I honestly believe that has a better chance of success, the checkbook diplomacy, because eventually people wake up and they get tired of having their wealth usurped and stolen from them. And it's a mystery to me, an enduring mystery, that it's the middle class of America that's just getting squeezed like crazy. They're being asked to pay for everything, mostly through the miracle of higher prices through inflation, so they don't really notice. But it's just extraordinary, the erosion of status and wealth that exists within the middle class, the explosion of the concentration of wealth into a very tiny upper percentage. And this is creating all sorts of stresses in the system. And it's one of the reasons I believe that you need to have precious metals or other articulations of real wealth, because we've been through this pattern so many times in history. When the currency finally gives way, what you have in a very dramatic fashion over a period of just a few months or maybe a year or two, an extraordinary transfer of wealth from those who own the paper markers to those who own the real stuff. And it's happened over and over and over again, and you can either be on the right side of that story or the wrong side. But if you're on the wrong side, it's extraordinarily painful. And we're seeing that, and my larger concern, is that might not just happen to us at the individual level, but that the strategic blunders being undertaken by the United States and Europe right now could easily see a rather dramatic, rather startling tilting of wealth transfer that will go from the West to the East, and that bothers me a lot.
Yeah, I see worsening stagflation pretty much all over the globe. It's just a whole bunch of different degrees, and I see governments basically underreporting it. I see unemployment numbers here in the U.S. that are completely cooked. I see consumer staple prices on a lot of items, food, energy, healthcare, insurance, education. Those prices are all going up. Electricity, cable, every single year, basically. They're almost going up at 10% per year. And then the discretionary items are doing what they're supposed to be doing because the consumer just doesn't have discretionary spending. They can barely afford staples. You're seeing, the discretionary companies barely able to survive in a lot of cases. You're seeing humongous sales, them closing stores, et cetera, et cetera.
Well, it's true that the numbers are cooked. They're always cooked, and that's just an age-old sort of government tradition, and all governments do it, and all administrations do it. And you understand the motivation for it. You want to paint things in a slightly rosier picture, and so we do. And I think those white lies are okay while you still have cheap, abundant energy and the pie is expanding. They turn into really dark lies when the pie can no longer expand, when we need honest instrumentation to tell us where we really are in this flight. And you're absolutely right. The cost of living is going up so fast. It's basically, for many people, turning into the cost of survival is what we have to measure now. We see that with just the absolute explosion in food stamp use that just doesn't comport with a stable job market or the income levels that are being reported or the inflation numbers that are being reported or the GDP numbers that are reported. None of those data sets actually comport with real data, which is how many people need food stamps now and qualify. And that's one example. And just to give us a flavor of how these statistics are heavily massaged, here's a concrete example from my own life. I just had to buy a new car, right? My 13-year-old Maxima finally wore out, and I have the original bill for it, and this is a regular, Nissan Maxima. I paid $17,800 for it in 1998 as a new car. And today that same car is about $28,000. Now, if you go into the BLS data set and you ask the question, hey, have automobiles, like that's pretty big inflation right there to go from 17 to 28. If you go in and you look at automobiles, according to the BLS, they have become cheaper every year. They are deflating. The price of them is going down year after year after year. So where my cost went from 17 to 28, right? Yeah, they hedonically adjusted that car and said, oh, look, it actually cost you less today than it did then. And I'll tell you what, it's the same car, pretty much. Better airbags, but not $11,000 worth of airbags as far as I can tell.
Yeah, you gotta plug in there for your iPod and maybe a smartphone player, but that's not worth the extra, the almost doubling in the price there.
No, it gets me to work at the same speed as before because of speed limits. But they say it's cheaper. I say it's $11,000 more expensive. That's how the game is played.
Well, I live right outside anecdotally, I live right outside the DC metro area here, and we supposedly have one of the lowest unemployment rates in the whole country. But the unemployment picture here, even in the DC metro area, is still quite high, and people, even with a full-time job, can barely afford food and rent. That's a lot of young people, in the mid-20s and 30s, and yet there's humongous property bubbles going on here because all the people at the top that make money, off the system, the lobbyists, the political cronies, and stuff like that, like the people on K Street, they've never been doing better. They have celebrity chefs coming in here left and right, building restaurants. You should come here, Chris. You want to see a property bubble? Come to the DC metro area, drive around for 2 or 3 days. It's like Miami and California from about 7 or 8 years ago.
It's great to be at the center of the empire as it's going through its final rating of the Treasury. All the funds flow towards the center. So that's completely anticipated, not surprising at all. And I'm sure for anybody who is younger, it's just an extraordinarily painful moment because we don't have corporate loyalty anymore. There's this, you're going to get a part-time job or several of them, and under no circumstances can somebody of median income means, I think, really survive in any of those areas. And so that's a mysterious area to me. All of Northern California is a mystery to me. I don't know how people who have regular jobs can even remotely afford to live there. And in most cases, they don't really. And that's part of this story. And so that constant cheerleading in the press to say we're on the path to recovery and still sort of holding to that meme that a rising tide lifts all boats, it's crazy.
Yeah, it's the Keynesian ideal about the animal spirits, got to promote the positive message no matter what. I mean, I would rather be honest with people and have people prepare, which is what you've done with your work, is, you lay out all the facts and you want people to say, well, you should start preparing for this and this and this because this is the truth based on my research and my knowledge, and that's just not what the mainstream media and the government like to do anymore.
That's absolutely right.
Okay, well, let's switch gears to the oil and energy markets, Chris, because you're one of my favorite oil and energy market analysts out there, and I've looked at a lot of their work. Based on your extensive research into oil and the energy markets, what do you think the mainstream media and Wall Street analysts are missing about the oil market right now?
Well, it's a complicated story, but it's not that complex. I'm surprised that we're this deep into it, and still the mainstream media is missing it. So here's the tale of the oil markets. First, it's a global thing. The fact that the United States has about 1.5 million barrels more production now than 4 years ago is a great statistic, but you have to understand it in the context of the larger world oil production, and that's been pretty much dead flat for about 6 years now. Worse, it's a tale of two grades. Oil isn't oil. There's two grades of it, grossly speaking. There's light sweet, there's heavy sour. The light sweet stuff is what we all want. It turns into diesel and gasoline and jet fuel relatively easily. There's not a lot of sulfur byproducts. It's got a very efficient refining process. That's the stuff we're in really short supply on. And so the United States marched in, helped Libya topple Muammar Gaddafi. It's now broken into a bunch of warlord, tribal sort of factions. And what we see there is that Libyan production of light sweet crude is basically lost about 1 million barrels per day over the last 2 years. So when we start to factor in what's really happening in the world oil markets, supply is tight relative to demand, especially for the grades of crude that we want. On the world stage, that's Brent crude. In the U.S., we call it WTAC, or West Texas Intermediate. But Brent is the world price for crude, and look at it. It's over 110 a barrel. So the idea that the world is awash in an energy revolution of cheap energy that's about to come flowing out of the ground because of a U.S. fracking miracle, you don't see it in the price, you don't see it in the supply, you don't see it in the demand data. So what we're seeing right now is very consistent with the idea that the world is actually in a fairly limited situation for good grades of crude oil. That makes a lot of sense. If the world economy suddenly sputters back to life, the trillions of QE and equivalents flow in, and we see 4, 5, 6% real growth on the world stage, literally the oil to power that does not exist right now from a supply standpoint, period. And so that's the larger context of what's happening in Syria and the Middle East, is we have to understand that if that goes hot and it takes out more Middle East production, we're actually going to get into a really dangerous situation with respect to crude oil supplies. That's what we need to understand. All the stuff about fracking and the miracle of fracking, it's really one of the largest PR campaigns I've ever seen. It's extraordinary, and those fracked plays are good, but they are not going to fix anything for very long.
Yeah, they're just postponing any potential, price spike there, in my opinion, where we get back to $180, $147 a barrel and perhaps higher, is because, every $5 or $10, the oil price goes up. Some of that marginal stuff, the oil sands, the Arctic oil, the deep water offshore, the syn crude that's from the fracking oil, the shale oil, the type formations, the enhanced oil recovery oil, all those things are not economic really, Chris, below like $65, $75 a barrel, right?
Oh, absolutely, and that's where the cost of capital that's as low as it's ever been. Meaning, Bernanke drove rates down so low that the companies that are operating in there, they have a risk-adjusted rate of return they're looking for that they have to have, because it's not simply a matter of plumbing. You just stick a pipe down and you get a defined flow that you can just put in a spreadsheet, and it's as good as it's a safe investment. There's still risks in that business. The plays are not consistent. There are sweet spots. There are less sweet spots. You have to factor all of that in as a drilling and leasing company. So it takes, given the inflation they've experienced in both labor and raw inputs like steel, close to double digits for the past few years. It takes, the cheapest plays I've seen, which have the best producing, maybe 60 a barrel. The worst ones, you need an 80 or 90. And so if we saw oil prices get back down to what I think is a consistent price with a robust world economy, which would be 50, 60 a barrel, you would see those plays shutting down in the sense that no new wells would be drilled. As soon as you do that, the production from those plays drops off a cliff. The average well there loses about 80% of its production in the first 3 years. It's just a really steep drop-off. Hey, as long as you're drilling 20,000 new wells a year, you can keep production up. But as soon as you stop that, it falls off very, very rapidly. So we're now in a position where we need high oil prices to maintain supply. That should tell us something about where we are in the story. And the world economy, to get the credit growth that it needs for the banks and the financial system to be happy, is not consistent with oil at these prices. That's what we're stuck in, and that's why this whole idea of driving interest rates to zero and just flooding the world with more and more QE, it's just a fool's errand at this point in time. We have to understand the energy E, the role it plays, and we have to start asking some serious questions, such as, what happens if world economic growth flatlines from this point forward because of the price of the liquid fuels that runs it? What happens? Well, I don't think you could support a case for equity markets at their current valuations, and I don't think you can support a case for bond markets in particular at their current valuations. Both of those are priced for a rapid resumption of growth. They're not factoring in the risk that we won't get that growth back. And by the way, the data's on our side at this point in time, right? When we look at how many years now have we had world economic growth way below the 4 to 5% that's needed to justify these bond and equity valuations, we're going on 8 years now.
Yeah, because a lot of these stocks, Chris, these companies are consumer discretionary items, and I just don't see the discretionary budget there for consumers to keep consuming at the levels they have. A lot of the reason that they've been able to consume for so long is, you have subsidized energy in OPEC. Even in the United States, you have subsidized oil price to a certain extent. You have, interest rates which were manipulated to low levels, trying to spur consumers to keep on consuming. And you have a lot of other, welfare programs and other centrally planned things to try to get people, give them as free and cheap of money as possible to keep consuming. So I don't think that's sustainable either.
No, it really isn't, and that's the thing that really drives me a little bonkers is that it's time to have a larger national discussion around where are we really going with all this. And I'd be a complete fan of fracking for natural gas and oil, and as long as we did it wisely, and we were using the energy that came out of that to build towards a future I could believe in. But the idea that we're going to get that stuff out of the ground and then promote, just additional vehicle sales and more malls and a little more suburban sprawl, and basically we're just going to use the additional time we get from these extraordinary, heroic, highly technical efforts to get more energy out of the ground to just continue to do more of the same. That all that happens there is that you're even larger and more fragile when you run out of that stuff eventually, and we will. And there's things we can be doing, should be doing, really ought to be doing at the national level to start maneuvering ourselves towards a different future. We're not doing that. We're consuming ourselves with a war in Syria, which honestly realistically is no immediate concern of ours. So.
I think the war in Syria, Chris, is more so over a natural gas pipeline which is going to the Mediterranean, and it's that the U.S. and the Saudis don't like OPEC doesn't want that, and they want to maintain the petrodollar. So I think this is a natural gas versus oil transition. Is the old status quo doesn't want the transition to natural gas to start occurring as rapidly on the world stage, and that's basically what's going on behind the scenes. I think this is over resources.
I think so too. I think, it just occurred to me that I need to rewatch the movie Syria, not just because the title evokes the country involved here, but I think it did a very credible job of explaining that this is all about power. You need to understand this through the lens of power. Money is power, but money is an abstraction. Real power is energy. And so understanding that energy dynamic and how convoluted it is and how many different forces of power are interested. You got Russia as a power center, China, U.S., so you got your geopolitical power centers, but then you got your corporate power centers. You've got these cultural. It's a very messy story. It's no one thing, but to say it's about humanitarian issues is really just for public consumption. It has nothing to do with what's really happening.
Yeah, I really don't buy that either, because it seems like the same song and dance that went on in Iraq, how, they had weapons of mass destruction and then they really didn't. It just seems the same type of story there. And we all know why we went into Iraq. It was mostly because Saddam wouldn't he was stopping taking dollars and he was going to start taking euros and get out of the petrodollar. And we went in there to try and get their oil.
Well, and how well has that worked out?
Exactly. I think we've spent a lot more money than the oil reserves they have. We've spent a lot more money on our military. So it shows you how inefficient central planning is. Well, Chris here, we're at our time limit, as you told me before the interview. I have a lot of other questions. I would love to get you to answer them, but I guess we'll have to wait till next time. So thank you very much for your time, and please tell our listeners where they can find all your work.
All my work can be found at peakprosperity.com. It's a wonderful website, large community there of people who are openly and curiously looking at the facts as they are and trying to decide for themselves how to become more resilient and be prosperous given all that's transpiring. So peakprosperity.com is the site, large community there, and a lot of contributors.
Okay, so thank you, and hopefully we'll have you on again soon.
Thanks, Jason.